Let's face it, YouTube doesn't have a shortage of videos on how you should manage your trades. Many new traders are at the stage of trying to determine the optimal position management strategy for themselves. So this will guide you and give you the clarity many new traders need, but don't receive. Even good traders fail to manage their positions optimally. If you stick to the end, you'll not only know how to take profits, but you'll also be able to see exactly where other traders are going wrong. Let's get into it. Position management needs to be reverse engineered to become optimal, and yet new traders don't realize their lack of trading experience can actually be their biggest benefit. Most of YouTube seems to fit into one of three categories when it comes to position management. First, the small win category. I risk $100 to make $25. This is the easiest way to appear to have an edge when in reality, because your target is 4 times closer than your stop, but you can appear to know what you're doing, even when you don't. The truth is, I have never seen anyone with a good profit trade like this over the long run. It's great if you want to fool your audience into thinking you know what you're doing, but it's not practical. The second is what I refer to as smoke and mirrors. These are money management processes that seem great on paper, but once you cut through the smoke, you see your account balance at zero, whether it's martingale, reverse martingale, or Kelly criterion. If your strategy doesn't have an edge, you're trading a plan that will go broke. Martingale often speeds up that process. Reverse martingale slows it down. And with the Kelly criterion, if you don't get the math correct, you'll still go broke. The third category is scaling. I've seen a lot of videos on scaling out and some on traders scaling into positions. Even though this could sometimes work, the problem comes down to the fact that most of these traders are attempting to level out their equity curve as opposed to maximizing profits while simultaneously limiting risk. If you've seen our other video on risk management, you know that a fixed lot size increases your losses and minimizes your wins, which is the exact opposite of what you should aim to achieve. This is why we choose a percentage of our account instead. We decrease the amount at risk after a loss and increase it after a win. For new traders, it's best to trade 1% or less until they can see their own win-loss ratios. But once you've entered a trade, what's next? Let's say you have 1% at risk. You've got a 4 ATR stop. Where do you place your target? The answer is, you don't. We trail the full position. To maximize profit, we need to keep the full position as far from our entry as possible. Scaling out of a position or having multiple take profits simply doesn't achieve this. And the best part is, as a struggling trader, this is one of the easiest management plans to follow. This allows us to catch trades with 10 or 20 times risk to reward ratios. So even if we lose a few along the way, our management will take care of those losses and then some. So how do we do this? Personally, I use the indicator on TradingView, which is linked in the description. When my trade is placed, I wait until I reach a 1.5 risk to reward ratio. Then I move my stops to break even. Then I do something many of you haven't or wouldn't think about. I move up to a higher time frame. Say I start on a 1 minute chart. I'll move up to the 5 minute chart and wait for a pullback. Assuming we aren't taken out at break even, If a new high is hit, I'll move the stop loss to below the swing low. Then I'll move up to the 15-minute chart and repeat the process. This means I'll eventually have 4-hour and daily charts where I'm holding my trade. By that point, I've locked in massive risk to reward ratios. This is the mistake most new traders make. I also only risk 2% per day max. If I place a trade at 1% and lose, I'll take another shot. But if the second one is a loss, I'm done for the day. Clearly, the charts aren't working for me, and it's best to wait for a new day. The only time I change this is after a 5% drawdown. Once my account is down 5%, I still risk 1% of the balance. But I will set a take profit to recover the loss and bring the account back to break even. I know what you're thinking. But what if this trade is the one that takes off and gets an 800 pip move? To which I say, great. In all likelihood, I'll be re-entering into the trend either later in the session or the next day. Remember, as accounts start to experience drawdown, we just move from offense to defense, looking to bring our balance back to break even by risking 1% of the account balance and being willing to play defense. I can tell you that after 12 years, I've never blown an account, and that should be your goal too. We're starting to wrap up our video series, but before we do, we need to uncover the truth about trading psychology, which we'll discuss in our next video. So make sure to subscribe and hit the notification bell to stay up to date when that video is released. Until then, signing off.